All right, now we find ourselves focusing on unrealized profit in trading inventories. So if there is any inventory that was sold, the seller will record sales as well as cost of sales because this is their inventory which they sold. So the seller is going to record cost of sales as well as sales. And this is going to affect our profit, right? So the sale between the parent and the subsidiary is an intra-group transaction and it has to be eliminated. So that sale transaction should be eliminated. So that's one elimination that we need to look at. The actual sales and the cost of sales that was recorded should be eliminated. The reasoning being the group is regarded as one economic entity and will not enter into transactions with itself. So what that means is you can't sell to yourself, right? So any sales that was recorded should be eliminated. Now, so that's the first elimination. Then the other elimination we need to talk about is if there is a sale, right, of inventory. Yes, we're going to eliminate that because it's intragroup. But if we sell it, company P sells to company S. If company S eventually sells to company X, then it is company S that should record the sales and cost of sales, right? Because it's selling to an external party. It's selling to a third party. So the only entity that should record the sale is the entity that eventually sells to the third party, a company outside the group. So the moment they sell it outside the group, then they can record the sales and the cost of sales. So sometimes when they sell, we have scenarios that can occur. Sometimes there's all the inventories have been sold. Right. So the only adjustments we need to make is the sales and cost of sales. Right. But this is not going to affect the profit because we're going to subtract sales and we're going to subtract cost of sales. It's the same amount. Right? So let's say that there was a sale made at the cost of, so the sales price is 1,000. Right. So we're going to subtract 1,000 Rand for the sales. We'll subtract 1,000 Rand for the cost of sales. Right. And then the net effect on the profit is zero because we reduced sales by 1,000, and we also reduced cost of sales by 1,000. So the effect on profit is going to be zero. And then sometimes there is inventories that were sold as part of the intra-group sales transaction that are still held within the group. Like you sell inventories worth 1,000, and then the 200, right? Then there's 1,000 is still remaining, right? What we need to eliminate for the inventories is the unrealized profit, right? So when there is an intragroup sale, of inventory, not just anything. It's inventory. Because if there is an intragroup sale of something else, then the adjustments will be slightly different, right? So the intragroup sale of inventory, we need to eliminate the sales of the seller and the cost of sales of the buyer. Basically, the purchases of the buyer. But the purchases will be obviously included in the cost of sales. So this is always the case where, regardless of whether there is any inventory remaining or not. Then secondly, we need to eliminate unrealized profit. In inventory that has not been sold. So if there is any intragroup inventory not sold, we need to eliminate the unrealized profit sitting in there. The reasoning there is, right, let's say entity P has inventory worth 1,000. Then it sells this inventory to S, the subsidiary, at 1,200, right? Do you understand here? Then this inventory at the end of the year remains unsold. So do you see that the inventory will be recorded at 1,200? Do you understand that? Because P no longer has this inventory, it has moved to S. And S bought it at 1,200. So in the accounting records of S Limited, the value of the inventory is 1,200. So at the end of the year, when we do consolidation, we sitting with inventory worth 1,200. But why is the inventory 1,200? Because when P sold, P included profit of 200. But you can't sell to yourself and make profit. So the profit that was made should be removed. For the inventory that remains unsold at the end of the year, the profit should be removed, right? And then if we remove the profit, then the group still has this inventory at its original amount. Do you understand the logic? Because if we sell at 1,000, if we sell goods with the cost of 1,000 and we sell them to a subsidiary for 1,200, then they remain unsold. The subsidiary has this in their records at 1,200. So when we put them together, we now have inventory. When we consolidate, we now have inventory worth 1,200. But why is it worth 1,200? Because there's a profit of 200. A profit from what? You can't be sitting with inventory and write profit on that inventory just like that. Because now when you consolidate, it becomes one entity. And you cannot then record the inventory at 1,200. We need to eliminate the profit. And the profit that is eliminated is for the inventory still in the warehouse that hasn't been sold. So we need to determine of all the inventory, right? So there's going to be inventory, but not all the inventory would have been part of the intragroup. So we only need the intragroup inventory, not all of it. And then from that intragroup inventory, then we need to eliminate the profit. Right. So remember that we need to determine, first of all, how much of the remaining inventory is intragroup. Because when an entity buys inventory, it doesn't buy inventory from one entity. It buys from many suppliers, supplier A, B, C, D. We are interested in the inventory bought from the group only. So we keep a track on that. Right. And then when we have figured out how much is that, we eliminate the profit. Okay. So there are two adjustments that have to be done. An adjustment of the sales and cost of sales, and an adjustment of the unrealized profit, which has to be subtracted. So that's the logic of the frame of approach that we're going to use. The technical details, we're going to show you now how that is done. Right, so we have cases, two cases. We have the first case whereby the parent sells inventories to the subsidiary. Right. So the parent sells to the subsidiary. This is referred to as a downstream transaction. Now, I want to repeat this. The parent sells inventory to the subsidiary. Who makes the profit? The parent has the profit. Right. The seller has the profit. And the subsidiary here is the buyer. The subsidiary, the buyer, has the asset. All right. So the seller has the profit. The buyer has the asset. Now, why is that important? Because when you do consolidation, right, the profit of the subsidiary has to be shared between the parent and the NCI. Right. So when we do consolidation, the profit of the subsidiary has to be shared. So we need to know who made the profit. Because if the subsidiary was the seller in an upstream transaction, the subsidiary sells to the parent. This is an upstream transaction. The subsidiary has the profit. So if we make adjustments to profit, unrealized profit, then we are adjusting the profit of the seller, of the subsidiary, in a case of an upstream transaction. So that means that before the sharing between the parent and the NCI, we first of all need to adjust the profit of the subsidiary, because the profit of the subsidiary is being shared. So before the sharing, we need to remember there is unrealized profit. The subsidiary recorded a profit, all right, when it's sold. But some of this is inventory is still held within the group, and we need to eliminate that. So when we eliminate, it is the profit of the subsidiary that is reduced. So it's important to understand who sold, because if the parent is the seller in a downstream transaction, then the profit of the subsidiary does not need to be adjusted. And then you can just share it because there's no adjustment. But if the subsidiary is the seller, first of all, you need to adjust the profit of the subsidiary and then share between the parent and the NCI. And I repeat again, if the parent is the seller, there is no need to adjust profit of the subsidiary, right? So that is why it's important to know who has the profit and who has the asset, right? It's also going to help you when we come to things like associates and joint ventures. It's going to help you a lot. So we have example number 3. And in this example, the parent sells inventories. Remember, this is not just any sale. It sells inventories to subsidiary. Right. We will demonstrate the difference between a sale of inventory and a sale of other assets. Right. Inventories to subsidiary. Remember, whenever there is a sale, intragroup sale of inventory, we're going to do elimination of sales and cost of sales. A very simple thing. We're also going to eliminate unrealized profit in inventory. Unrealized profit in inventory. Right, so this is the situation that we have. We have A limited and B limited. And the year is 31 December 2008. Right? So let's listen to the story. Right. Additional information. Point number 1. A Limited acquired its interest in B Limited at the time of incorporation of B Limited. Right. So that is fine. B Limited, so A Limited is the parent and B is the subsidiary. So B Limited, B, who purchased here? B, the subsidiary. So the subsidiary purchased all. Right. That is very important because we need to know how much of the inventory was bought from the group, members of the group. We are being told here it's all. So you need to pay attention to how much of the inventory, right? Because sometimes it's not all, it might be 50% or 30%. So the subsidiary purchased all its inventories from the parent at a cost price. So there's a cost price plus 25% profit. So it is the profit that we are particularly interested in if there is any inventory at hand at the end of the year, which means that the inventory of the subsidiary will be including the profit that was charged by the parent. But you can't charge yourself profit and then the value of your asset increases. So the inventories on B Limited's financial records amounted to 20,000 at the beginning of the year. So that's 1 January. So if 20,000, 1 January. All right. So this is very, very nice. And A Limited's total sales to B, this is an intragroup transaction, is 100,000 for the year. Now let me just break this down for you properly. So the story here is last year, A sold to B. This is last year. And the inventory that remained unsold last year is 20,000. So that's why it's the opening inventory, right? Okay. Then this year, A sold to B. The total sales is 100,000. Then out of that 100,000 that was sold, the unsold inventory at the end, the closing inventory, we have to check it now in the records of B because we have been told that all was bought from A Limited. So we go to inventories and we see that it's 30,000 remaining. But we're going to take the whole amount because all the inventory was bought from the parent. So I want you to listen to this explanation I'm going to give you very carefully, right? Because the concept itself might be straightforward, but sometimes the format of the question might be tricky. Right, the first thing, if there's an intragroup, is to eliminate the intragroup cells for the year. So we're going to have cells, right? So the cells of A plus the cells of B. So I'm not going to write down the amounts. It's not necessary, right? And I'm going to show you exactly how you do it. Cells of A plus cells of B minus 100,000. This is the intragroup cells because we can't record cells to ourselves. You don't sell to yourself. So this would be an inflation of cells, rather, an inflation of cells or too much cells. It's not necessary. So then we have the correct amount of cells. Then our cost of cells. We have the cost of cells of A, right, plus the cost of cells of B minus the intragroup cells, 100,000. We're subtracting here because the seller recorded sales of 100,000. The buyer recorded purchases of 100,000, right? So the purchases will be included in cost of sales. So we need to say, no, these purchases of 100,000, you can't purchase from yourself. So we're going to eliminate sales of 100,000. We're going to eliminate purchases of 100,000, right? So that's a lot of marks. Then you get your gross profit. Now, I said to you, I want you to follow carefully. Do you know, or rather, do you see here that if we reduced the sales by 100 and we also reduce the cost of sales by 100, the gross profit is not going to change, or the profit is not going to change because we have reduced the sales by the same amount that we're going to reduce the cost of sales. So we have sales 100,000 reduced by 100,000. Cost of sales reduced by 100,000. The effect on profit is 0. I want you to underline that. Why am I saying that? Because when you are preparing an income statement, a complete income statement, you will have to subtract the 100,000 from the sales. They will say prepare the profit or loss and other comprehensive income. Right? Then you start with sales, cost of sales, gross profit, other income, other expenses, and so forth, and so forth, and so forth. Right? Now, you will have to subtract this if you are preparing a complete income statement. But now the point I want to emphasize is if you are starting from profit before tax, or sometimes they give you and you have to start from profit before tax, you don't have to adjust the sales and the cost of sales because you're starting from profit before tax and going downwards. You're not starting from sales, cost of sales, gross profit. Now, this adjustment for intragroup sales will not affect profit before tax because this adjustment doesn't change, has no impact on profits. So the profits will remain as they are. Right. So you don't have to say profit before tax, like here, and then you say, so in this case, they gave us profit before tax. So you don't have to say profit before tax 80 plus 60, and then you subtract 100 and plus 100,000 because the effect of the intragroup sales transaction is 0 on profit. Right. So you are not going to say, you are not going to say 80 plus 60. Then you say the effect of the intragroup sales, you are going to say 80,000 of 100,000 minus 100,000. Then that just becomes 0. Right? And so there was no point. So it's important for you to know that. Now, we want to go next to the unrealized profit. So we're going to start with the unrealized profit for this year. So what happens with the unrealized profit for this year is that unsold inventory has profit. We need to remove that profit, right? So that we don't record inventory holding at a profit, because we are just holding the inventory as a group. So where did the profit come from? We're just holding the inventory. We are one entity. So we need to eliminate that. Right? So who is the seller? The seller is the parent. 80,000 of the parent will include, because the parent says they sold already, so they recorded their profit. But some of the profit is not yet realized, and it's profit on 30,000. Right? This is cost price plus 25%. So the unrealized profit there is 25 over 125. Right? We say 25 over 100 plus 25. So that's why we get 125. So if the profit was cost price plus 20%, we would say 20 over 100 plus 20. Right? But now it's 25, so it's 25 over 100 plus 25. So the profit is 25 over 125 multiplied by the inventory, 30,000. And remember, this inventory is not just all the inventory of the buyer, but the inventory of the buyer, which they bought from an intragroup transaction. So what you're going to do there, you're going to say 25, right? Let's do the calculation. 25 divided by 125, right? Multiplied by 30,000. So there's 6,000 here sitting in these inventories, which is just profit sitting there. And where did the profit come from? So we need to eliminate it. Right. So we could come and say 80,000, the profit of the seller, right? The seller is the parent. And to say minus 6,000. Right. But we do not do it like that. We do it differently. The effect is the same. Right. But we don't do it like that. Now, when I say we don't do it like that, I'm saying I'm going to present two scenarios. The first scenario is when we have to prepare the entire income statement with sales, cost of sales, gross profit. So when we prepare the entire income statement, we need to remember that during the current year, we would have said sales here and to say minus 6,000 because that's not it. But we don't do that. Instead of subtracting the profit from the sales figure, we add that profit to cost of sales. So it's the same effect. The effect is the same. We could subtract the 6,000 here from the sales, right? Which basically means we have reduced income. Or we could add it here on the cost of sales, that's 6,000. So whatever we do, we are going to reduce profit by 6,000. We could subtract directly from sales to say, no, there's something that is not yet realized. You can't record that as sales. Right? And but the way we do it by adding the unrealized profit in closing inventory to say, no, this is not yet sold, right? So instead of subtracting it from sales, the profit, we add the profit to cost of sales, right? But the profit at now, this is unrealized profit at the end of the year. So when it comes to next year, we're going to assume that it's going to be sold, right? So this is 2008. So in the year 31 December 2009, all right, we're going to assume this has been sold. So when we prepare for 2009 next year, we're going to subtract this from cost of sales, right? Because we assume we had it from the beginning of the year, and we're going to assume, no, now that inventory has been sold. As a result, we can realize that profit. And we realize the profit by reducing cost of sales, right? So how do we deal with unrealized profit? When we're preparing the entire, right, when we prepare the entire income statement, starting from sales, we have unrealized profit, right? Unrealized profit in closing inventory. We said this should be added to cost of sales. We add to cost of sales to eliminate the profit because it's not yet sold. The inventory is there sitting in the warehouse. So where is the profit coming from? We haven't sold. So we have to say this is unrealized profit in closing inventory. When we prepare the entire financial of the income statement, we need to add that to cost of sales. Then in the following year, when we prepare, it becomes opening inventory. Right? So unrealized profit in opening inventory should be, we assume now it has been sold. So we now need to deduct it from cost of sales. So if we deduct that from cost of sales, our cost of sales becomes smaller. That means the profit is going to increase by 6,000. Right? So instead of going to add it under other income or whatever, we just adjust the cost of sales. Right? So I want you to understand that when we haven't sold inventory at the end of the year, the unrealized profit in closing inventory is added to cost of sales. If we are preparing a complete income statement, right? And the unrealized profit at the beginning of the year is deducted from cost of sales. This is when we are preparing the entire income statement. But sometimes we are not preparing the entire income statement. We are starting from profit before tax. So we need to think in terms of what is the effect of each on the profit. So if we are dealing with profit before tax, right, we have a figure for profit before tax, right? And we're starting from there. So if we have unrealized profit in closing inventory, we need to remove it from profit. So we're going to subtract, right? Right? But if we have unrealized profit in opening inventory, right, we need to add it to the profit because now we believe we have sold this. It's a transaction from last year, but we believe now that inventory has been sold this year. So now we can realize the profit this year. So when we're starting from profit before tax, we need to reduce the profit before tax with unrealized profit in closing inventory because it's not yet profit. So we reduce that. And then opening inventory is now profit, you add it. So it's very important to understand where we're starting from. Sometimes the examiners want you to start from profit before tax. So this is what you do. So I want you to write it down. If you start from profit before tax, this is what you do. If we're going to prepare the entire income statement, then the effect is on cost of sales. This is what you do. Right? Then the other thing, finally, is now our inventory is no longer 30,000. we have subtracted 6,000 unrealized profit. And just a formality now to calculate the unrealized profit at the beginning of the year, 25 over 125, right, multiplied by 20,000. So I think that's 4,000. Right. So we have to add 4,000 to the profit before tax and subtract 6,000 from the profit before tax. Remember, this 4,000, I didn't calculate it with a calculator. It's just from my head. Maybe it's slightly different. So basically, this is what you need to pay attention to. And remember, this is a parent selling. So it's not, the adjustment to profit is not going to affect the analysis of equity. Because analysis of equity, we are looking at the profit of the subsidiary. And as we look at the profit of the subsidiary, we want to see, do we need to adjust that profit? So this adjustment here is not going to affect the analysis of equity because the subsidiary is not the seller. Right? So what am I going to do here? So there is the inventories, the 6,000 being subtracted. So basically that's the story. So don't worry about the rest here. We want to emphasize one thing. So now because we're starting from profit before tax, we have that profit before tax. And if we subtract sales and add purchases, this is 0. So you just leave it. You just leave it. But now you have to subtract the unrealized profit in closing inventory and add the opening because this is now realized. So that's all. Then the rest is your standard stuff. So don't worry about that. I want to show you that the profit of the let me go back. I want to show you that the profit of the subsidiary is 60,000, right? Then we subtract taxation for the year, it's 20,000. Do you agree? And then this is 40,000. The profit of the subsidiary is 40,000. I just want to highlight that it's not going to be adjusted because the subsidiary was not the seller. We're just going to share that. One gets 80%, the other guy gets 20%, and we're done. All right. But you will see now when the subsidiary is the seller, then we have to adjust this profit to say where there are some adjustments to be done. Right. So I don't want you to worry about this. Right. You should have perfected your understanding of this now. So I don't want you to worry about that. Now, a little bit of the explanation and a comment just to make sure we repeat that explanation. So they say that in this example, the parent sold inventories to the subsidiary. So the unrealized profit was included in the profit of the seller, right? And therefore there were no adjustments in the analysis of B because B, the subsidiary, is not the seller. Also note that sales and cost of sales are not always given in quotients. You will then have to make all adjustments against profit before tax. Right. So sometimes you have to do the complete thing. Sometimes you just start from profit before tax. Right. So we need to eliminate all intragroup transactions. Right. As the single entity will not enter into transactions with itself, we should eliminate any sales between the group. Right. So we'll eliminate 100,000. We also eliminate the cost of sales, 100,000 for the other guy. Right. I think I've explained everything here. I haven't left anything. Right, so so now when it comes to the subsidiary selling inventories to the parent, the thing is the subsidiary has the profit. So if there is anything, any profit that is unrealized, it has to be adjusted in the analysis of equity. Because before we share, we need to do adjustment. Now we're just going to walk through this quickly, right? So we are told that D, so we have D and E, right? So we're just going to focus on the purpose of this learning unit, right? We're not going to cover everything, just focusing on the inventory only. Right, so they sell, the cost is 25%. All right. Now we're coming from profit before tax. It's 80 and 60. So there's no need for us to adjust for sales because it's a zero. All right. Now what do we do here? So we start with 25 over 125 multiplied by 40,000. This is at the beginning of the year, right? So it's 25 divided by 125 multiplied by 40,000. So 8,000 has to be added to the profit of the subsidiary. Because remember, this opening inventory, right, was denied last year because last year it was unrealized. It was closing inventory last year, right? And so the seller was denied a profit of 8,000, right? But now we assume this has been sold, so we can say, okay, we can give you that profit of 8,000. Right? And then I'm also going to show you the journal entries that are done, and then we should be fine with inventory. Right now, and how much is it for the current inventory? It's 30,000. So that's 6,000. So we are denying the seller 6,000 the current year, and we are giving them 8,000. Remember, these adjustments are pro forma because in the financial records of the seller, they've recorded a sale, and they're not going to make any adjustments. Now, it is us who at group level are trying to consolidate and we are adjusting the amounts. So we go to the profit of the seller, we add 8,000, which we denied them last year, we're giving them this year. But this year we're denying them the 6,000 to say it is still within the group, right? So when you do the analysis of equity, this is what I want to emphasize on. When you do the analysis of equity, you have the profit of the subsidiary, right? You see now. And then we have to add the opening inventory unrealized profit and subtract the unrealized profit for the closing inventory to say, no profit was made yet. We still have this, but this we assume it was sold. It's an assumption. So what they are going to share is not the 40,000, the profit after tax, but it's the 40,000 after adjusting for unrealized profit. And the 38,000 is what they are sharing. So what I want you to understand here is please pay attention to who is the seller. Because if the subsidiary is the seller, any unrealized profit has to be adjusted in the analysis of equity. Right. So basically that's all. So then the other thing that I would like to emphasize on, so don't worry about this. Right. I want you to, let me see if then there is income. The sales have to be debited. The cost of sales of the buyer have to be credited. Now, this is important. So I wanted to focus on this. because we haven't covered this yet. And this is a standard journal entry that they will require from you. The cost of sales. Now we have calculated the unrealized profit. Why is it 8,000? What did I do? No, I'm sorry. This is supposed to be 30,000. So this is supposed to be 6. Right, that's what I think. So I think there's a typo. Right, that's supposed to be 6,000. Because I think I saw the inventory as 30, but maybe I made a mistake. But whatever, I'm going to explain the principle. So this is another batch of journal entries that I need you to know. It's an addition from what we have always covered. Okay, so you intragroup sales, you debit, intragroup cost of sales, you credit. Simple thing. Then, with regard to closing inventory, we need to increase the cost of sales. But this is the cost of sales of the seller. Now, I want you to understand that, because when we debit the cost of sales, we are increasing the cost of sales. To increase the cost of sales means we are denying someone their profit. But I said to you, we don't subtract the profit from sales. We actually we subtract it from by adjusting the cost of sale. Right. Remember that when I said, we could have said sales and minus the 6,000. But we're not going to do that. We're going to do that to the cost of sales. So the cost of sales of the seller, do you understand that? Has to be increased by 6,000. We've denied them their profit. If we increase the cost of sales, we've denied profit. Then we credit the inventory because the buyer has the inventory. Right? So we're going to credit that inventory. Now, this is unrealized profit in closing inventory. I'll go back to the analysis of equity to show you something. Now, for the opening inventory, last year, the seller, remember, recorded this as a profit already. So in the books of the seller, the separate financial records, in the books of the seller last year, the profit is sitting in retained earnings. And we have to go to that retained earnings of the seller and say, no, you can't recognize this. So you have to deny them their retained earnings. So which means the opening retained earnings has to be adjusted of the seller, the opening retained earnings of the seller. Because in the retained earnings of the seller, they already recorded the profit. So it's sitting there. So we go to their retained earnings to say, opening retained earnings minus 8,000. Now, because this is unrealized profit in opening, we assume the inventory has been sold, right? And so the cost of sales of the seller can be credited. Now, if you credit cost of sales, you are reducing cost of sales. And if you reduce cost of sales, you have reduced an expense. If you reduce an expense, you increase profits. So here we're going to reduce the expense of the seller by 8,000. Now it means we've given them the profit. So I want you to make sure you can do this because it's crucial. This is very crucial, especially when you go to third level. You get a lot of marks for this because now at third level it comes with adjustments for deferred tax and income tax and stuff like that. So, but then before you can apply the deferred taxation, you need to have arranged this correctly first. The opening inventory, so they will say to you, do the journal entries for inventory, and they give you 10 marks, sometimes 12 marks. You have to say this and that deferred tax and this and that deferred. You get a lot of marks, but you need to understand the basic now. So I want you to make sure you can understand this. Now, if we go to retained to the analysis of equity, the retained earnings will have to be subtracted. You subtract that unrealized profit, that 8,000, to say, no, you guys recorded this already in retained earnings, but there's an amount that wasn't realized last year, which was only realized this year. So let's subtract that amount from last year retained earnings, and let's include it now in the current year profit. So we're subtracting 40,000 times 25 over 125 from last year's records because it was not yet realized then. And now we include it during the current year because it has been realized. Right? So in conclusion, I'm going to tell you the things I want you to understand. First of all, make sure of the direction of sale. Who is the seller? Who is the buyer? If the seller is the subsidiary, this is an upstream transaction. Means the profit of the subsidiary has to be adjusted. Right. So the profit of the subsidiary has to be adjusted. If there is anything not yet realized. So that's the importance there. And I want you to remember that this adjustment, regardless of who is the seller, the adjustments for opening inventory will affect retained earnings. So now, if this is the retained earnings of the subsidiary, you need, of course, we need to subtract any unrealized profit for whether the seller was the parent or the subsidiary. But if the subsidiary was the seller, we do this so that we can share the correct retained earnings between the parent and the NCI, right? So that's why it's particularly important. So when we have opening inventory, there is going to affect retained earnings. And we need to adjust then the retained earnings of everybody, of the seller, whether the seller is the parent or the subsidiary. But if the subsidiary is the seller, then we do it specifically in the analysis of equity to share the correct retained earnings. 4, cost of sales is going to increase by unrealized profit in, right? So let me say the adjustments are like this. For a full income statement, right, the adjustments are our sales of the parent plus sales of the subsidiary, right, minus the intra-group sales. So that's going to be our sales. And cost of sales of the parent plus cost of sales of the subsidiary, right? Plus, all right, let me start by subtraction. Then we subtract intra-group sales. Underline that. It's subtracted also from the cost of sales calculation. Then we add unrealized profit in closing inventory. It has to be added to cost of sales. If you add that to cost of sales, then you have increased the expense and lowered the profit. So you are reducing the profit by the unrealized profit in closing inventory because this is not yet realized. But the one we had at the beginning, the unrealized profit in opening inventory, now you need to subtract that from cost of sales. If you subtract from cost of sales, you reduce the expense, you increase profit. So you are basically saying, let us now give the seller the profit, right? That is if you're doing a full income statement. If you're starting from profit before tax, right? So you have the profit before tax of the seller, right? Plus profit before tax of the, no, not of the seller. Why did I say the seller? The parent. Where am I now? Of the parent plus profit before tax of the subsidiary. Then you have to say minus unrealized profit in closing inventory, because now you are going directly to the profit. What's the effect of the unrealized profit in closing inventory? To reduce profit. So instead of reducing profit by adding this unrealized profit in closing inventory, instead of adding it to the cost of sales, we just subtracted it directly if we are dealing with profit before tax. We don't have to increase an expense and then that expense reduces profit. We're going to go directly to the profit and subtract. Then for the unrealized profit in opening inventory, we go directly and add to the profit before tax instead of going through cost of sales and reducing cost of sales, because we are not doing a full income statement, right? So I said I need you to know that, right? Then fifth, I need you to know the journal entries, right? Sales, so this is your debit, this is your credit, right? So we're going to have sales of the seller has to be debited, and cost of sales of the buyer is going to be credited. Is that difficult? Then we come to opening. So this is the intragroup sales. Then the unrealized profit in opening inventory. We first of all deny the seller their retained earnings. So retained earnings of the seller has to be reduced. And later on during the year, the cost of sales of the seller again has to be credited to say. So we first of all deny them the profit that they already recorded last year, to say, no, you don't record this last year. You record this year. Right? So we are denying them last year and giving them the profit this year. Right? So this is opening inventory. Then unrealized profit in closing inventory. We deny the seller. So we're going to do the cost of sales of the seller. Right? To say, no, you haven't realized the profit yet, and the inventory of the buyer is inflated. Like that. Right? And so I've also emphasized to say, remember who is the seller, who is the buyer. Because if the subsidiary is the seller, then you need to do the adjustments to the retained earnings of the subsidiary, to the profit of the subsidiary, and then the corrected amounts have to be shared. But if it is the parent who is the seller, a downstream transaction, then you just adjust, right? You don't have to go to adjust the profit of the subsidiary. You just adjust in your calculations, and that adjustment is complete because there is no sharing. All right, I hope you found this very informative, right? Okay, so I want you to practice. When you practice, I want you to practice these two cases, right? Example 3, right? So we have example right? I want you to do example 3 and example 4. In your practice, I want you to sit down and actually do right. The statement of financial position, don't worry about it. That's not important. I want you to do the income statement. Right? And the statement of changes in equity. So earlier on I said don't worry, but I want you to do that because there is adjustments that are important there. And the analysis of equity. So this is going to be soft, but the other one, I want you to be able to do these last journal entries, which I showed you. Then also example 4. So I want you to practice that. So I want you to, whether after listening to this, it's perfectly fine, then you can take your learning units. You can take your learning units, you sit down, you try to do a proper work. See if you can draft the income statement, the statement of changes in equity, and the journals for both examples, and see what you have missed. Brilliant. So that is it for inventory.